Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's been going on in investment markets and what to look out for in the days and weeks ahead. Now, I delayed this week's show deliberately by one day, and that was because there was the potential market moving event of the US Federal Reserve's latest interest rate meeting occurring, and that occurred yesterday. That was Wednesday. So, of course, leading into this meeting, the market has been told endlessly by the Federal Reserve that inflation was transitory, and inflation has been one of the key factors that has been influencing market movements of late. Of course, if you go back to all these videos I've been doing, you will hear a lot about the reflation trade. So what happened is the US Federal Reserve caught the market by surprise, and that was because it was surprisingly hawkish. What they did is the language and the forecast suggest that the Federal Reserve is likely to raise interest rates in 2023 now, rather than 2024, which was the earliest date that was expected. They also suggested that core inflation in America would be nearer 3% this year, which is sharply higher than the 2.2% that they'd predicted previously. So this started to suggest that inflation was becoming a bit of a problem, and that caught the market off guard. Now, obviously, the Federal Reserve was very keen to dictate the narrative around this particular meeting, and there was lots of language that was trying to suggest that things wouldn't be as bad as people would think if they started to taper monetary policy, if they started to unwind QE or raise interest rates. And that would actually be a positive, bullish thing to happen, which is a strange thing because normally it's seen as obviously a negative, because if there's less monetary stimulus in the pipelines, then it tends to mean that equity markets and asset prices tend to fall. But they've turned us it's going to be a positive. Now, what did it mean for markets? If you look at equity markets, it's quite interesting actually. Now, equity markets, broadly speaking, pulled back about 0.5% after the announcement. So that means that we saw the S&P 500 come back to around about 4,223, which is still above where it was last week. So that 4,200 level is still above there. We're still near those all-time highs that have just recently been set. Look at the FTSE 100, for example, today we're around 7,158, which is still above where we were this time last week when I did this show. But broadly speaking, the market is down around about 0.5%. That's most equity markets I'm talking about. In the immediate aftermath of that Fed meeting, the markets in America, they were still open at the time, did pull back further. They were down at one point, almost at 1%, but then they rallied. And a lot of those losses were recovered. And we, like I say, finished down around about 0.5%. So it seems that equity markets are taking this all in their stride. And interestingly, I'm always keen to look at the Dow versus the NASDAQ. So the Dow Jones, how did that perform? Because that is one of the sort of reflation indicators that we've had in the past. And actually the NASDAQ marginally outperformed the Dow Jones. So that's something to bear in mind. Will we see the reflation trade ignite or not? Because at the moment, markets aren't getting carried away with the inflation story just yet after this meeting. But look at the fear gauge, the VIX I often talk about, which gives an indicator of sort of sentiment, really, fear in markets in the US. And that was around about 18. So long-term average is around about 20. It's at about 18, which is only marginally up on the 17 figure last week. So that's nothing to really write home about. Equally, the similar fear index, the equivalent on the NASDAQ, was broadly the same as where it was last week as well. So based upon what equity markets have so far done, it's early days after the Fed meeting, they have taken it in their stride, and we've not seen any aggressive sell-off, because that was one thing that people were worried about. But if you look at other markets, then the story isn't quite the same. Look at bond markets. So the 10-year US Treasury yield has actually rallied at one point. Well, it rallied at one point to almost 1.6%, which is quite a big move from the 1.44 that we were at earlier on in the week. And it's now settled somewhat. I mean, if you look in the UK gilt yield has rallied in tandem. So we've gone from 0.75% up to 0.82% in the aftermath of that Fed meeting. So the bond market has sold off. When yields rise, remember, it means the prices of bonds are falling. So the bond market, which seemed to be not believing this inflation story, is now trying to reprice. and take account of what the Fed has said. If you look at the dollar index, that's up 1.3% after the Fed meeting. If you therefore look at the pound-dollar exchange rate, the pound has actually strengthened against the dollar. If you recall, we were around about $1.41 for the pound last week. We're now down to about 1.395. So the reason the dollar has strengthened is obviously because if rates rise, it makes the dollar more attractive, and therefore people want to buy the dollar and it pushes up the price. So we're seeing a stronger dollar. That's quite a counter trend to what we'd seen recently, where the weaker dollar has been pushing up things like emerging markets and commodities and US equity markets themselves. So we've seen a little bit of pullback in all of those things. We've got to see what happens in the coming days. That explains why gold got hammered yesterday. So the price of gold has now fallen through $1,900 per ounce, down all the way through actually $1,800 per ounce. It means that in the last week, we've fallen about 5%, which is a big move. I mean, in the last quarter, gold has been a pretty decent investment, actually, given the fact that it had been a laggard, particularly against other inflation hedges that some people use, a bit like Bitcoin, for example. So we're seeing a pullback on gold. We could see further weakness going forward. That would be interesting, so keep an eye on that. But at the moment, while equity markets are taking this in their stride, other markets aren't at the moment. Bond markets aren't. Commodity markets aren't. It'll be interesting to see what happens in the days and weeks ahead, and in particular to keep an eye on those reflation trades. So keep an eye on what financials do, for example. So that is it for this week on Damien's Midweek Markets. A lot to keep an eye on in the coming days. You can contact me as ever. Damien at moneytothemasses.com is the email address. Twitter, moneytothemasses with the number 2. Of course, you can find us on Instagram, Facebook. Don't forget to join our Facebook group, facebook.com/groups/moneytothemasses. And do subscribe to our YouTube channel.